Yo, what's up everybody, it's 10x Rank, and let's be real, things are looking rough out there in the market. We're seeing red across the board, news headlines screaming about crashes, and everyone's freaking out. But here's the deal, panicking helps no one. What separates the successful investors from the rest is what they do during times like these. That's why in this video I'm breaking down the top 10 ways to protect your money, and even potentially profit from this bear market. So, smash that like button, subscribe for more financial breakdowns, and let's get this money. Look, I'm gonna be straight with you. When the market takes a dip, the first thing you need to do is get your own financial house in order. That means tightening up that budget and plugging any leaks where your money is mindlessly going out the door. Remember, cash is king, especially in a bear market. So where do you start? I want you to grab a notepad and let's do this together. Go through your bank statements, credit card bills, and those sneaky online subscriptions you probably forgot you even had. Be ruthless. Every dollar you save right now is a dollar you can use to buy assets at a discount when others are panic selling. Trust me, having that safety net is priceless. Alright, let's talk investing strategy in a bear market because this is where most people trip up. It's easy to get caught up in the panic and make hasty decisions that can hurt your portfolio in the long run. Here's the golden rule. When the market is uncertain, you need to be extra careful about where you put your money. This is the time to be more conservative and focus on preserving your capital rather than chasing high returns. This is not the time to be gambling on meme stocks, chasing the next hot crypto coin, or listening to your buddy's guaranteed investment tip. These high-risk investments can be tempting, but they can also lead to significant losses. Remember, a bear market is like a truth serum for companies. It reveals the true strength and weaknesses of businesses, separating the wheat from the chaff. Those with shaky fundamentals, weak business models, and mountains of debt, they're gonna get exposed and their stock prices are gonna get crushed. It's a harsh reality, but it's also an opportunity to see which companies are truly resilient. On the flip side, companies with strong balance sheets, solid earnings, and a track record of performance, they're the ones that weather the storm and come out even stronger. These are the companies you want to keep an eye on and consider for your portfolio. Don't get caught up in the hype or the fear-mongering. It's easy to be swayed by sensational headlines and market noise, but staying calm and focused is key. Remember, slow and steady wins the race, especially in a bear market. Patience and diligence will pay off in the long run, so take your time, do your research, and make informed decisions. You know that saying, don't put all your eggs in one basket? It's a classic piece of advice that holds true in many aspects of life, but it's especially crucial when it comes to investing. Well, in the world of investing, it's not just a saying, it's the gospel. Diversification is a fundamental principle that can make or break your financial future, especially during a bear market. Diversification is your best friend. When the market is volatile, having a variety of investments can help you weather the storm. Why? Because it spreads your risk and protects you from catastrophic losses. By not putting all your money into one type of investment, you reduce the chance of losing everything if that investment fails. Think of it like this, if your entire portfolio is invested in tech stocks, you're essentially betting on one sector. And if the tech sector takes a nosedive, your portfolio is going to feel the pain big time. This can lead to significant financial stress and potential losses. But if you're diversified across different asset classes, sectors, and even geographies, you're way better insulated from those sector-specific shocks. This means that a downturn in one area won't necessarily drag down your entire portfolio. You're spreading your investments across various markets and industries, which can help balance out the risks and rewards. Consider adding some defensive stocks to the mix. These are stocks that tend to be more stable and less affected by market fluctuations. These are companies in sectors like healthcare, consumer staples, and utilities. They provide essential services and products that people need regardless of the economic climate. And hey, don't forget about dividend stocks. These stocks pay you a portion of the company's earnings just for holding them. These bad boys pay you just for holding them, which can provide some nice passive income. This can be a great way to generate additional revenue without having to sell your investments. This passive income can help cushion the blow if the market takes a tumble. It's like having a financial safety net that can support you during tough times. So remember, diversification isn't just a buzzword, it's a crucial strategy for managing risk and ensuring long-term financial stability. Diversify your portfolio and give yourself the best chance for success. Chapter 4. Build your empire. Create multiple income streams. Let's face it, relying on a single source of income is risky business, especially in today's economy. A bear market can often lead to job losses, wage stagnation, and overall financial uncertainty. That's why it's more important than ever to create multiple streams of income. Think of it like this. Each income stream is like a pillar supporting your financial house. The more pillars you have, the stronger and more resilient your finances become. Freelancing is booming right now with platforms like Upwork, Fiverr and Guru, connecting skilled professionals with clients worldwide. The e-commerce boom isn't slowing down anytime soon, and platforms like Amazon, Etsy, and Shopify make it easier than ever to start selling products online. These streams can generate income even while you sleep, giving you more financial freedom and security. Chapter 5. Don't panic, resist the urge to sell low. Alright, let's address the elephant in the room, panic selling. It's the biggest mistake investors make during a bear market, and it can absolutely destroy your financial future. Here's the deal. When the market tanks and everyone around you is freaking out, it's natural to want to sell everything and run for the hills. But here's the thing. When you panic sell, you're essentially locking in your losses and missing out on the eventual recovery. Remember, bear markets are cyclical. They don't last forever. The key is to avoid making emotional decisions based on fear or short-term market fluctuations. Think of it like this. When a stock goes on sale, you don't freak out and return everything you bought at full price, right? You see it as an opportunity to buy more at a discount. Chapter 6. Invest in yourself. Knowledge is power. You know what the best investment you can make is, no matter what the market is doing? It's investing in yourself. Seriously, your skills, your knowledge, and your mindset are your most valuable assets, and they only appreciate in value over time. The beauty of a bear market is that it gives you the perfect opportunity to level up your financial literacy and become a smarter, more informed investor. So, how do you invest in yourself? Read books by investing legends like Warren Buffett, Ray Dalio, and Benjamin Graham. Take online courses on financial modeling, technical analysis, or whatever piques your interest. The more you learn, the more confident and prepared you'll be to navigate any market condition. Alright, let's talk about a powerful investing strategy that can actually turn a bear market into your advantage dollar cost averaging, or DCA for short. This method is particularly useful for those who want to invest in the stock market but are wary of its volatility. By spreading out your investments over time, you can mitigate the risk of making a large investment at the wrong time. Instead of trying to time the market and invest a lump sum at the perfect time, which is impossible to predict by the way, you invest a fixed amount of money at regular intervals, regardless of the market price. This approach ensures that you are consistently investing, no matter what the market conditions are. For example, let's say you want to invest $10,000 in the S&P 500, instead of putting all your money in at once, which could be risky if the market takes a downturn right after. You spread it out. Instead of dumping the entire amount in right now, you could invest $1,000 per month for the next 10 months. This way, you are buying shares at different prices, which can help you avoid the pitfalls of market timing. When the market is down, your fixed investment buys you more shares at a lower price. This is one of the key advantages of dollar cost averaging. You are essentially buying more when prices are low, and when the market is up, you're buying fewer shares at a higher price. While this might seem like a disadvantage, it actually balances out over time. Over time, this strategy averages out your cost per share, potentially boosting your returns. The idea is that you end up paying a lower average price per share than if you tried to time the market. Plus, DCA takes the emotion out of investing. By sticking to a regular investment schedule, you avoid the stress and anxiety of trying to predict market movements. This can lead to a more disciplined and successful investment experience. Chapter 8. Play it safe. Explore recession-proof investments. Even in the midst of a bear market, there are always opportunities to be found. One smart strategy is to focus on recession-proof investments. These are companies and sectors that tend to hold up relatively well even when the economy takes a downturn. Think about it, no matter how bad the economy gets, people still need certain essential goods and services. That's why investing in sectors like healthcare, consumer staples, and utilities can be a smart move during a bear market. By focusing on these essential sectors, you can potentially mitigate your risk and position your portfolio for greater stability during uncertain times. Chapter 9. Play the long game. Prepare for long-term gains. Listen, one of the biggest secrets to building wealth in the stock market is understanding this simple truth. Bear markets don't last forever. The market moves in cycles, and what goes down must come up. The problem is most people panic during a downturn, sell their investments at a loss, and miss out on the eventual recovery. Instead of trying to time the market, focus on time in the market. The longer you stay invested in quality assets, the more time you have for compounding to work its magic. Remember, history has shown time and time again that the market always recovers. Every major crash, every recession, every bear market has been followed by a bull market, and those who stayed the course have been rewarded for their patience and discipline. Chapter 10. Mindset is everything. Cultivate a wealth-building mentality. Here's the deal. When it comes to navigating a bear market and achieving financial success, your mindset is everything. It can either be your greatest asset or your biggest liability. You see, the rich don't think about money the same way the average person does. They see opportunity where others see fear. They see bear markets as a chance to buy assets at a discount and set themselves up for even greater wealth down the road. Instead of viewing a bear market as a threat, see it as a challenge, an opportunity to learn and grow. Remember, building wealth is a marathon, not a sprint. Outrow, stay smart, stay strong, stay invested. Boom, there you have it. My 10 essential tips for not just surviving but thriving in a bear market. If you found this video helpful, hit that like button, subscribe for more financial wisdom, and smash that notification bell so you never miss an update. Bear markets can be intimidating, but they don't have to derail your financial goals. Stay smart, stay strong, stay invested, and as always, crush it out there.